Hello, everyone, and welcome to our YouTube podcast on the benefits of investing in ETFs in India. I'm your host, Sandeep Chhabria, and joining me today is Mr. Sandeep Chhabria, a financial expert with more than 20 years of experience in passive investing in India. Mr. Chhabria is the lead of passive business at HDFC Asset Management, and he has a deep understanding of the ETF business in India. So, in this episode, we're going to explore the whole world of ETFs, their advantages over traditional mutual funds, the different type of ETFs that are available in India, the tax advantages that you can get from ETFs, and so much more. So, let's dive deep into this world of ETFs and get the valuable insights from Mr. Sandeep Chhabria. So, welcome, Sandeep. Welcome to our podcast. So the first question that I want to ask you today is that what is an ETF and how does it differ from a traditional mutual fund?
The full form of ETF is an exchange traded fund. So, as the name suggests, it is a fund, just like a mutual fund, but there is one difference that it is traded on the exchange. So, the commonly followed exchanges like NSE and BSE, these mutual funds are basically bought and sold primarily on the exchanges. Hence, the name exchange traded fund.
Right.
So a normal mutual fund, if you see, you come buy and sell from the asset management company itself. And
Yes.
here you can buy it on the secondary market, or you can also approach the AMC. So majority of the trades happen on the exchange. So hence the name exchange traded funds.
Right. So a traditional mutual fund, I get allotted a unit after a day or two, whereas here you can buy it.
So let's say, for example, if you have 10,000 rupees to invest and you want to invest in an actively managed fund, let's say it's a flexi cap fund. So you approach the AMC and basis the realization of the funds, and 3 o'clock would be the cutoff time for a normal equity fund. You will
Right.
be allotted units at an NAV, which is the end of day NAV.
Right.
Whereas an exchange traded fund actually has a structure of a mutual fund, but
Mm.
the way the transaction units are allotted is like a stock, like a
Yes.
equity share.
Right.
So you can actually put a limit order, you can decide the price of the ETF at which you want to buy. If there is a seller who wants to sell at the same price, the trade gets executed.
Yeah.
And you will be allotted units in the demat account on that T plus one settlement, which is
Right.
what is followed for equity shares. So
Right.
there is a moving price, it's a traded price, a quoted price on the exchange at which the allotment happens. Rather than in a mutual fund, it happens at an end of day NAV, which is known only the next day by the investor because it is released in the night.
Right. So this is really interesting, and I have a couple of more questions propping up,
Sure.
based on this explanation. But the
Yes.
first thing I would ask is, so what is the advantage of this ETF which is traded on the exchange compared to the other investment options?
So I guess ETF basically has an underlying basket.
Mm.
Basically, an ETF for an index fund, they generally mimic a commonly followed index.
Right.
Like if you take the popularly followed indexes like Nifty 50 or Sensex 30, what they will do is that the ETF will mirror the returns of the index.
Right.
And when they do that, what happens in an ETF is that there is a basket of such stocks. So if Nifty 50 has 50 stocks, it would be
Mm.
a basket of 50 stocks, but the weightage will be as per whatever the weights are allotted in the underlying index.
All right.
So what happens during market hours is that all the 50 shares price keeps moving up and down. So
Mm.
the quote keeps changing. So in
Right.
an ETF, basically the basket value keeps changing live with the underlying in line with the underlying share prices.
Right.
So that so there is what you call indicative NAV or INAV for that
Mm.
particular basket. So that gives you a sense of what is the value of the basket at a particular point of time.
Right.
So one can actually go and buy the units of the ETF at that particular price or sell at that particular price. So you need not wait till end of day, just like in a mutual fund
Right.
that you do, and then wait to know what the price is. So that is the key feature of an exchange traded fund. It trades like a equity share, but the underlying characteristic is of a mutual fund.
Right.
So,
So yeah. So
so it's, yeah, go ahead.
Sandeep, you've been working in this industry for more than 20 years, right?
That's right.
In the
That's right.
passive industry, and so I would love to know, how do you guys structure these products, and how are these funds managed? Because it is a complicated thing that you also have to follow an index, plus it is also being traded, right? It's a
Yes. So the product idea comes from the underlying index.
right.
So, NSE and BSE, they have a lot of
Mm.
indexes which they, what you call, release. So the
Right.
most commonly followed products which are designed around the indexes are the market cap weighted indexes.
Right.
So you will have large cap indexes, you will have mid cap indexes, you will have small cap indexes. So those, you would have heard of, like, if we just look at the NSE, for example. So the largest stocks would be the Nifty 50, then would be the next 50. Then there's a combination of both Nifty 50 and next 50, which is a Nifty 100. And then you would have the Nifty mid cap, which would be the next 150 stocks from stock
Right.
number 101 to 250. And 251 onwards till 500 would be the small cap index.
Right.
So the ETFs are designed around these indexes, and
Mm.
their job is to faithfully follow that index. They should give
Yeah.
the same returns as the index, less the expenses which are charged in the underlying ETF to run the ETF, and that difference can be also called like the tracking difference. So
Right.
there is another question on tracking error which we can cover subsequently. So
Right.
the market is dominated worldwide also by the market cap weighted indexes,
Yeah.
and the more commonly followed indexes are the largest in size in terms of assets under management.
Right.
Same is the case with India. The Nifty 50 and the Sensex 30 ETFs, which are offered
Mm.
by various mutual funds, are the largest in terms of size of
Right.
the ETF market. So ETF market, if you see, they have equity and debt and commodity products,
Mm.
okay, largely. So out of which two-thirds of that AUM is dominated by equity-oriented ETFs.
Right.
So within that two-thirds of equity-oriented ETFs, 80% are all market cap weighted
Right.
indexes, ETFs. So this is what I told you, like the Nifty 50
Yeah.
ETF or the Sensex ETF, those would be the more popular ones.
Yeah.
So what happens is that their job is to faithfully, track the returns of these underlying indexes and do it at a very economical cost. And what happens is that just like a stock, like if you say, for example, which is in the index, like HDFC Bank, somebody wants to buy at a particular price, sell at a particular price. Here you can intraday buy and sell the index at a particular price. So
Right.
you need not wait for the closing index. Let's say the market is down 2% now, but by the end of day it recovers. So when you invest in maybe an index fund or any actively managed fund, you will have to go by the end of day price. But let's say if the
Right.
market is down 2% intraday and via ETF, I can actually go and buy the index at that particular point of time when it is down. So
Yeah.
thereby I can enhance my return. Similarly, if the market is up, but it closes down or flat, but I want to capture the upside when I'm selling the index, it is possible to do that in a ETF. So that is a fundamental change.
Right.
So market cap is the most commonly followed, the most widely used ETFs. Then you would have sector ETFs, which are also very popular, where
Mm.
like NSE would be having a Nifty Bank Index. They would have a Nifty IT Index. They would have, let's say, a Nifty Auto Index. They would have, let's say, a Nifty PSU Bank, a Nifty Private Bank Index. So ETFs actually also are available where you can capture the sector returns,
Right.
underlying sector returns via that ETF. So
Yes.
that is another segment which is also structured in India. And then there is something called, there are two other categories. So fixed income right now is not that popular. Liquid or that
Mm.
one day return ETFs are popular with the in the second with the securities brokers, the
Right.
PMS providers or the AIF providers. On the retail side, the other common ETF which is popular are the commodity ETFs like gold ETF and
Yeah.
silver ETF. So
Right.
they follow the returns of the commodity, and
Right.
you can buy the ETF, and then you are actually buying physical gold without taking delivery of it, and you are saving on storage costs. There is no purity problem because it is 99.999% pure, and
Right.
it is backed by the custodian with actual physical gold. So
Right.
this can be bought and sold also, and that is very popular. And then you have a certain ETFs which are rule based or factor based. That is,
Right.
there is an underlying rule basis which the ETF index will be constructed, and that's how it will be managed. So you have, if you, I mean, if on the active side you say one fund manager style is a growth style of investing, or
Right.
it is a value style of investing. So similarly, you have these ETFs which are value ETFs, growth ETFs, quality ETFs. So these are certain parameters which are pre-decided basis that the stocks are filtered if they qualify for these parameters. So these are called
Right.
smart beta ETFs. So
Yes.
they are also offered by NSE and BSE. So you can have a smart beta strategy. So
Right.
there are some smart beta strategies which are not on fundamental factors, they are on technical factors. So you have a momentum based strategy or you have a low volatility strategy. So
Right.
those are also popular.
Yes.
Of course, they are very small a percentage of the overall size, but these
Yes.
are the things which are becoming more popular as the
Yes.
investor awareness of ETFs is going up.
In fact, we have a Sandeep, we have our advisory portfolio where we have this ETF, and recently we have actually included this momentum and low volatility ETFs because
Correct.
your infra, PSU bank, banking,
Exactly.
those are more
Exactly.
popular, right?
Right. Right.
Right. And obviously, India is still a developing market, and in the US you have so many more categories,
Yeah.
right?
So if you see as a percentage of the total assets under management for mutual funds in India, let's say is around 42, 43 lakh crores. So ETFs are only 16-17% of the AUM. Whereas,
Okay.
let's say in a place like US, almost 50% of the AUM is passive and dominated by ETFs. So there are
Right.
actually ETFs which are the size of our mutual fund industry overseas. A single
Oh,
fund. So it's like a very big trend in US and has been for last 10, 15 years.
right.
And that is something where, as you rightly pointed out, as the market gets larger, more developed, more liquid, then these passive funds start to gain more popularity.
Right. Right. So I actually used to work with a investment advisor in the US before
Right.
this, and
Oh,
so we only used to allocate to ETFs. We didn't look at stocks, right? Because
right.
that was a
So,
big
yeah,
market.
so there it
Yeah.
is the other way around. Here, maybe in a portfolio, investors are now allocating 5, 10, 15% to passives. Whereas
Yeah.
in US, there 80% is passive and 20% is only active. So
Right.
that's the opposite end of the spectrum.
Definitely. So, but obviously they have these ETFs have a lot of advantages, right? So, like diversification is one key advantage that they can bring to a normal retail Indian investors
That's
portfolio.
correct.
So, yeah.
So
So you can talk.
diversific. So as you are investing in an index, it is not one stock. There would be
Yeah.
50 stocks, 30 stocks. Even in a sector fund, there would be 20, 30 banks in an FT bank. There would be a mix of private and public sector banks. So you have diversification which is available
Right.
in the ETF. You have a low cost. Most of them are run at very economical cost because they have to track the index and they can't keep the cost very high because then the tracking difference or tracking error there can be an impact.
Right.
Then convenience is there. They can be bought and sold on an exchange. There is liquidity
Right.
for someone who wants to exit. And then the allotment happens in the demat account. So it's one view. Whether you buy for ETF from whichever fund, it will be allotted in your demat account. So you don't need to have separate statements for each mutual fund investment that you do. So, and the other thing is you're able to capture the returns of the underlying index or the ETF very efficiently.
Yes.
So those are the key advantages, and it's very transparent. And there is what you call regular disclosure by all the mutual funds on the underlying
Yeah.
ETFs. So I think those are the advantages: the operational convenience, transparency, liquidity, low cost, and as the other parameters like tracking error and tracking difference
Yeah.
are there, those are also very competitive.
Right. So, is an ETF advisable for everybody, or do you think it is suitable for only one type of investor profile?
So if you see, like in India, the ETFs have become popular ever since the EPFO, changed the rule that there could be an equity allocation
Hmm.
within the, because it's largely a fixed income portfolio what they run.
Right.
So they started with 5%, then they went up to 15%. So thereafter, if you see, this happened sometime in 15, 16.
Yeah.
Thereafter, there has been an explosion in the AUM of
Hmm.
ETFs which are managed in India. So these retirement funds, EPFO, they are the large investors in ETFs. Then you have treasuries of banks and insurance companies. They also take exposure to ETFs. Then you
Right.
have proprietary books or large family offices which are run. They also like to take exposure to some extent of their portfolio through ETFs. And HNIs are there who directly invest in ETFs where
Hmm.
they want to take a call on a sector, but they are not sure of taking a call on a particular business because the risks exposed in that business are more. But they are clear on the direction of the sector. So then it's advantageous for them to buy a sector ETF rather than just one stock. So they can
Right.
capture the sector upside, but they are not necessarily exposed to the business risk for one particular entity. So
Right.
those are the investors. Right now, what we are seeing is that retail interest is also picking up in
Yeah.
ETFs as the awareness is growing amongst investors.
Right.
So right now, it is you could say that we are at the stage where it is dominated by institutions and HNIs, but it will become more and more a retail product as time goes by.
Right. Okay, that's really interesting for me. Now, now you've been talking a little bit about tracking error here and there, right?
Correct, correct.
And this concept is extremely interesting for me. On how do you guys manage that tracking error? So if you could talk more about it, what is the
So
significance of this number?
yeah, so the tracking error is nothing but the standard deviation of the difference between the index
Yeah.
return and the underlying ETF. And
Hmm.
that is one of the parameters which fund managers, when they invest in a particular ETF, they look for. How
Right.
faithful are you in replicating the index returns?
Right.
The lower the tracking error, the better the fund is able to track the underlying index returns. And that is why it is preferred to be invested in. Because see, here there is no fund manager, there is no
Hmm.
active management of funds which happens. You're basically going to mirror the returns of the underlying index. So
Right.
because of which the one who does it really well is
Hmm.
the one who is managing the fund very efficiently.
Right.
So one of the key components, of course, would be the expense which you run these ETFs at.
Right.
Secondly, is how you are managing the inflow, outflow, which you get, plus the rebalancing which happens of the underlying indexes, which generally happens twice a year for most
Right.
indexes. How well you are able to manage that. So all these have a bearing on this tracking error.
Hmm.
And just like, let's say, for when you are advising somebody on active fund, and then you look at the Sharpe ratio, and you say
Hmm.
higher the Sharpe ratio, the better the fund is managed. So here,
Right.
lower the tracking error. Those are one of the parameters on which the ETF or index fund's performance is judged.
Right.
So this is one of the key components which even very large investors also look at when they are shortlisting which ETF or index fund that they should invest in.
Right.
So this is an important parameter, and most fund managers are very mindful of keeping the tracking error as low as possible, and they adopt
Yes.
various strategies. So there is operational efficiency plus,
Hmm.
let's say, if they have underlying stocks in the ETF, they can also participate in that securities lending and borrowing mechanism as a source of
Okay.
income, which will drive down the cost of the ETF further. So that
Okay.
actually reduces the tracking error.
Okay.
So there are various measures which are adopted by the fund managers, the dealers, and the operations team to try and keep this tracking error as low as possible. So that
Definitely.
if you get a trade, you are getting a fresh inflow where you have to create units. You do
Right.
it as quickly as possible so that there is no idle cash. If a cash component is a big part of an index or ETF, they are not able to then faithfully replicate the index for that cash component. So
Yeah.
generally, unlike an active fund where a fund manager keeps some portion in cash so that they can take care of redemption requirements, here the fund managers try to keep the cash component as low as possible because
Right.
that has a bearing on the tracking error.
Right.
So that is why it is an important parameter, one of the important parameters when one is shortlisting a index or a ETF. And this is
Yeah.
disclosed by all mutual funds on AMFI's website on a daily basis.
Yeah. So while it looks very simple that you are just tracking a index, but it
Yeah,
shows a complicated structure underneath, right?
exactly.
Behind.
So SEBI, supervises this very carefully. So all fund houses are very careful that their tracking error is at a minimal
Right.
level.
Yeah. All right, Sandeep. So we talked about the mechanics of ETFs. What are the tax advantages do you think that ETFs can bring to somebody's portfolio?
So the tax is as per the underlying asset class. So in case you have 100% equity oriented ETF, so the tax rule is beyond 65%, it qualifies for equity taxation. Same thing would be the what you call rule for the ETFs, and
Okay.
majority of them on the equity side, so they qualify for the equity benefit, which is that uh, if you are keeping an investment for less than 12 months, then it is taxed at 15%, the gain plus the surcharge and cess, whatever is applicable. And if it is beyond 1 year, then the tax rate becomes 10% plus the surcharge and cess. And there is a exemption limit of up to 1 lakh rupees for long-term capital gains on the equity side. Only the
Right.
gains which are booked, which are more than 1 lakh rupees, then you are supposed to pay tax on that at the rate of
Right.
10% plus underlying surcharge and cess. For gold and fixed income, up to last year, if somebody had invested up to 31st March, even for overseas assets, there was an indexation benefit available. And if
Yes.
someone held on to the units for more than 3 years and less than 3 years, it would be as per the marginal rate of tax of that particular individual. But now, post 1st April, there's a new regime where the indexation benefits are not available for gold or fixed income anymore.
Right.
They are irrespective of the period of holding. You have to pay the marginal rate of tax for any gains which is realized by the individual.
Right.
So tax advantages are the same as what is available to an underlying what you call asset class.
Right. But like if you are buying equities, then you don't get that 1 lakh exemption, right? Which you're getting.
You do get in equities as well. So
You do.
similar thing is available in the ETF as well.
Okay.
So that's what I was trying to
All right.
communicate.
Perfect. So, ETFs, I've heard a lot that they are used in tactical allocation and,
Yes.
portfolio rebalancing. So, would you talk a little bit about that?
So, as you know, the in markets, equity markets, generally the winners keep changing.
Hmm.
Generally, there is one segment of the market, whether it's basis market cap or it is a sector bias, which does well and better than other parts of the market. So, if you see that somebody has an allocation in equity,
Hmm.
and they, let's say to begin with, they have a higher weightage to large caps than mid and small caps in their overall equity portfolio. So what happens is that when the large cap stocks generally they lead the rally when there is a bull run, and that's when
Hmm.
they do well. But then when market conditions change, the macroeconomic outlook changes, interest rate outlook changes, or the rally becomes more broad based, then the mid cap and small cap sectors also start performing, and they will then large cap would be the leaders, but mid and small would then be outperforming them as the rally, tenure is longer. So what one can do is that you can dynamically, change your allocation like from large cap to mid cap, and you can reduce your exposure to large cap, increase your exposure to mid and small cap. So these are the tactical changes that one can do basis the ETFs. And similarly, I'll give an example. As I told you, sector ETFs are also popular. Let's say
Right.
banking sector was something which was not doing well in the past, and then the fundamentals of the banking sector changed. where the NPAs came, to a very low level as compared to the past. The credit cycle picked up after many years, basis the economic growth, and that was going in double digits. So if somebody took a call on the banking sector basis this what you call data which was available, then one can invest in a Nifty Bank ETF. So if you see
Yes.
Nifty Bank ETF in the last 1 to 3 years is one of the better performing ETFs. Within that, if one were having a valuation bias or a value bias, then PSU Bank ETFs, which PSU banks, had thus far trailed the private sector banks, but their balance sheets got repaired and their balance sheets were also growing because of the pickup in the credit growth. But they were available at, maybe half or one fourth of the valuation of the private sector banks. So somebody took a call and invested in a PSU bank ETF. They were handsomely rewarded and they have
Right.
done very well in the last 1 to 3 years. So one can take tactical calls and maybe like supposing the interest rates have peaked out in India and maybe there would be rate cuts in India, maybe in the next 6 7 months, a rate cutting cycle may start. Then you can, there are these, you have these growth ETF or a quality
Yes.
ETF, which I had spoken about, or even a IT ETF, which those are the sectors which are the, a relatively higher PE ratio than the normal market. They start doing well in a low interest rate regime where
Right.
so then one can tactically, book profits from one sector and go to the next sector. So this rebalancing of a portfolio and taking tactical calls on which sector or which segment of the market to be in can be used very well through, ETFs. So those are the
And
advantages
yeah,
which are
and with
there in retail.
ETF, you don't have any of the entry exit cost apart from the brokerage that you pay, right?
Exactly, yeah. So that is there, and so basically, it allows even a retail investor in his portfolio, or even a ultra HNI investor in his portfolio, to take these calls very dynamically.
Right.
So, and because the liquidity factor is there,
Right.
and one can rebalance on their own. So, I think that is something which is becoming more and more pronounced. That's why these smart beta ETFs
Yeah.
are becoming popular. Like supposing the markets, had not done much for, let's say up to March last year, and they have picked up now in April onwards on the back of some huge FI buying, and somebody enters a momentum ETF.
Yeah.
So they will be rewarded when they enter, and then as the tide changes and the momentum slows down, one can go for a low volatility kind of ETF, which is more stable
Right.
and which will do better if the market is flattish or trending downwards.
Right.
So these strategies are becoming more popular amongst more informed investors, and once retail investors also understand how to use, depending on the market conditions, which of these ETFs, and they're all diversified. It's not just one single stock. So
Yeah.
in that sense, they are able to take care of these portfolio rebalancing and tactical call requirements of the investor.
Right. Perfect. And the universe is also expanding, right? I think a few years ago we only had a limited number of ETFs, and now you have so many sectors and themes, right?
Yeah, so I'll tell you, for us, we have 17 ETFs and we have 12
Mm-hmm.
index funds. So there are every month there is a new launch of
Oh,
an
wow.
ETF. So it could be a new segment or a new index which is launched for the first time, or somebody would be launching the similar index. So you have a choice which AMC or mutual fund to choose
Right.
when you are picking a particular strategy of any ETF.
So my last question to you, Sandeep, is that if there is a retail investor who is considering investing into ETFs for the first time, what would be the advice that you would give them?
So I think for a first-time investor, I think ETF is a great product to capture market returns, the underlying index returns.
Mm-hmm.
And if you have a demat account, you have a trading account, you can do so. So what one should look out for is look at how the ETF has been managed, how old it is. If it's been managed for some time, that's always a plus point. If there is something if one is just going for a plain vanilla Nifty 50 or a Sensex ETFs, then one can go with any of the fund houses because you're just buying the underlying index. But it would be preferable to go for fund houses which are already established, have been around for some time, they have been through cycles, and they are faithfully able to replicate the index returns. So those are the ones they should look out for. And there are many fund houses, like for instance, our two index funds are Nifty and Sensex index funds are more than 20 years old.
Oh,
So,
wow.
yeah, so that's a very long track record of managing those funds efficiently. So, a first time investor can look for that definitely. And I think the benefits of diversification are there: low cost, transparency, and also the way it is, the tracking error is less, so it's able to replicate the index quite well. Those are the factors one should look for
Right.
when shortlisting a particular ETF. And diversification, as you said, is one of the key advantages of putting in an ETF. You have a moving price for a portfolio of investments rather than one particular
Hmm.
single unit of investment. So
Right.
you have the advantage of an equity share, but at the same time, you have the diversification of a portfolio.
Right.
So you have advantage of a mutual fund and you have advantage of an equity share. Both combined basically gives you the ETF. So
Right. Yeah.
that's
So,
best of both worlds, as you can put it.
yeah. So if there's a new investor, instead of them buying one stock, it's better for them to buy this basket of stock, and
Yeah,
something like that.
exactly. So in case somebody likes a particular sector like auto sector or telecom sector is expected to do well this year, and that trend may continue for some time for whatever reasons, because now post COVID, now there's a huge pickup and demand in mobility again. So these are sectors which can benefit from that. So one can go and buy the auto ETF, which is available at a very reasonable cost, and you can capture the sector upside.
Right.
Similarly, if one wants to capture the market returns, you can always just invest in a Nifty 50 or a Sensex ETF, and you can capture those returns. So a lot of options are available today to the investor, and you can have direct equity exposure as well. But it makes sense to not just have that and try to hedge your bets and
Right.
uh, capture at least the beta which is there in the market rather than
Right.
always chasing the alpha.
Yeah. Yeah. So this was really insightful, Sandeep. I got a lot of insights about the ETF market, and I hope the viewers also got this. Thanks a
Yes.
lot for coming on our show. And
You're most welcome, Sonam. It was a pleasure interacting with you, and look
yeah,
forward to many such sessions.
same here. Thank you, Sandeep.
Thank you. Thank you very much.
So that concludes an insightful session on investing in ETFs in India with Mr. Sandeep Chhabria. We hope that you found this podcast extremely useful and you understood the key benefits of investing in ETFs. ETFs offer you diversification, flexibility, and even some tax advantage that make them preferred instrument not just for novice investors but also for experts in the field. Before making any investment decision based on this podcast, please do your own thorough research and consult your own financial advisor. Our aim is to keep on bringing you such educative content and create such engaging podcasts that help you in your own financial journey. Stay tuned for more such podcasts where we bring you insights on many other financial topics. Thank you for joining us, and we look forward to having you in our future episodes as well. Happy investing.